Hi, my name is Reed Silverne. The name of the show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker and proud of it. Actually a retired federal worker right now. And I'm going to do the traditional spin of the earth. There we go. And I'm going to reposition America over my shoulder here. Today I'm going to talk about a number of things while I adjust my sound check and do everything else. As I've said in the past, what you see is what you get, because this is live to tape. And what live to tape means is whatever I say actually comes out on tape, except that I'm here on Friday, and you'll see this either Sunday or Tuesday. If I fall off the chair, you're going to see me fall off the chair. If I mess up the cameras and disappear and then reappear suddenly, you're going to see that on Sunday or Tuesday, as I just did. I am my own engineer. I have a low-tech show, and I even now have a little Fed Pride symbol underneath me, which is great. So that's basically how this show works. And I have Google Earth behind me. And right now I'm focused on the United States because I even take a look at foreign newspapers, Spanish, French, so on and so forth, English, British papers. And the big story in most places is what is going to happen here in the United States and who is going to be our next president. And also what's going on with our economy, and is our economy going to bring down the economies of the rest of the world. Basically, we had a subprime mortgage meltdown, and what that means is in order to fix the last recession, and that recession started with a stock boom and an internet collapse around 2000, 2001, the collapse of Enron, a bunch of companies that were valued at tremendous amounts, but were really buoyed up by basically financial reporting frauds. All that collapsed in the early 2000s, from 1999 to 2001, and the result was a tremendous drop in the stock market. As a result, recession hit. This recession was not as bad as it could have been, not as bad as some recessions we've had back during Carter era, stagflation, the Nixon era, and so on and so forth. But for a country that had just gone through the 90s, the boom 90s, it was quite serious. As a result, two things occurred. There was a big tax rebate in 2001, and some limited tax cuts that same year. That was after Bush had gotten in there. And the other thing that happened is the Federal Reserve started lowering interest rates. And that occurred until about the next second Bush administration, and the interest rate started going back up again, started being raised back up again to protect us from inflation. Commodities prices were going up, so on and so forth. So as a result, the mortgage companies and the banks, of course, had the eased up, deregulated credit card markets and so on and so forth. So they were able to get tremendous, unprecedented margins between the amount of cost that they had to pay for money and the amount that they charged for money. And same thing with the mortgage companies. Of course, when the interest rate started to go back up again, they tried to string it along by increasing volume, even when the margins were going down. How did they increase volume? They basically packaged mortgages that had initial rates that were very low. Housing prices had charged up during this period of low interest rates, and in order to keep the buyers coming in, especially in the expensive areas like California, or the have fast-growing areas like Nevada and Arizona and Florida. And the other expensive areas like Washington, D.C., New York, New Jersey, Boston, so on and so forth. The way to keep the buyers coming in was to charge very, very low initial interest rates that would balloon out later. Some of those were subprime. People didn't have perfect or very, very good credit. They were still allowed to borrow with no downs, be able to get into the market. Hopefully the value of homes would go up and they'd be able to sell out before the interest rate went up and it boomed. A lot of people went into these mortgages with their eyes open, trying to buy more house than they could afford, trying to buy more houses than they can afford, flip this house and so on and so forth. And a lot of them actually just, didn't understand the 30 pages or 20 pages of fine print and just went in sight unseen. And now there are very, very high default rates. Default rates started last year, started charging up last year. But meanwhile, the banks, the mortgage companies packaged these subprime mortgages and sold them through the markets, which put them together in new types of securities. Now, every time there's been a new wave of new kinds of financial transactions and so on and so forth, where basically things that are done on a contractual basis are wrapped up and then bought and sold on the open market. The first was the derivatives, and derivatives led to a massive perturbation in the market. There's a very, very famous case of a controller in Orange County who played with derivatives, lost his shirt, and collapsed a fund that caused municipalities all over California to actually lose their shirts and lose a lot of money. The other famous derivative story is the trader in Barclays, right down there, and I believe it was Hong Kong over here, but it might have been Singapore. I think it was Hong Kong. Actually brought one of the oldest British banks in history to a complete disaster by investing in and playing around with derivatives. And derivatives are basically hedges on various things that the market could do positively or negatively. The other thing that occurred in the 90s were funds that basically bought on margin trillions of dollars worth of various currencies and caused a lot of the currency crises of the 90s. Well, the currency crisis of this decade, which I call the noughts and other people call the preteens, 2000 to 2010, include these securities that basically are bunched up mortgages and are bought and sold in the open market. There's rights, there's these mortgage securities, and basically they were bought by Merrill Lynch, by Bear Stearns, Goldman Sachs. They were also bought in mass by certain banks up in Europe and Asia, and even Dubai and places like that. And when we had our subprime meltdown, it caused HSBC, one of the biggest banks in Switzerland, and some other banks to come under tremendous pressure. Some hedge funds collapsed, and there was lots and lots and lots of trouble. So that's what's been occurring. And basically, that's the background for our current meltdown. What is causing a recession? Well, it's never the primary reason. It's not basically the housing, although housing has slowed down. But it's because consumers, which is 70% of the American economy, are now realizing that they are not getting richer just by owning a house. For years and years, during the 90s, during the noughts, people had a house. They opened up the newspaper every single week. They opened up the real estate page, and there's a house that's sold in their neighborhood for more than they bought it for, and more than the last house that sold in their neighborhood previous month, previous week. So people felt like they were getting richer and richer. They were more willing to spend, and that spending has supported not only our own economy, well, especially not only our own economy, because we've been outsourcing like going out of style, and it has basically supported China's giant rise, the outsourcing to India, basically in our global economy, the global consumer. And the basis of the global economy is our consumer right here in the United States. So if the United States goes down, not so much our manufacturers, not so much our capital goods manufacturers or our car manufacturers. A lot of those plants are overseas, and even though our economy has dropped from 1/3 of the world market to only 1/4, basically we are still the consumers of the world, and a lot of the world is dependent on us to feel rich enough to go into debt, to hit our credit cards, and to buy Chinese goods, South Korean goods, Japanese goods, European goods, and so on and so forth, South American goods. So they are dependent on us, and what we do and how we abuse or use our economy is very, very important. Now, as we know from the name of the show, Fed Pride, I was a federal worker and I just retired, and our federal retirement system has a TSP, which is a basically in a nutshell a 401k. And a 401k, one of the funds, or one of the major funds that a lot of people put their money into, is called the C Fund, and that's based on the S&P 500. So the S&P 500 just took a big dive just this last week. And of course, I always say, whatever I say on Friday, it's going to be probably wrong on Sunday and wrong on Tuesday. And probably the people who watch this show on Tuesday are going to say, what's he talking about? S&P 500 is not taking a dive. Stocks are going up or stocks are going down. It's hard to say what's going to happen next week compared to what happened this week. But this week, the S&P 500 has taken a dive of over 100 points. The stock market has taken a dive of close to 1,000 points. The Dow index. And basically, our stock market all of a sudden started really charging down after it had been going up for the last couple years. But has it really been going up? And I did some charts for myself just to take a look at it. The background of this whole thing, and the reason I'm talking about it in the context of all the politics, Romney, who I can't stand, reminds me of the worst boss I've ever had. He won in Michigan. So at least on the Republican side, we've had Huckabee winning in Iowa, McCain winning in New Hampshire, followed by Romney winning in Michigan. The next round is the Nevada caucus on Tuesday, and the following week is the very, very important South Carolina primary, which kind of indicates how the other side, the South, is going to go. South Carolina is right there. So meanwhile, we've had the Federal Reserve has come out and said we're on the edge of a recession. We're teetering. We need to do something about it. There's been a number of Fed interest rates lowering, and that hasn't seemed to have solved anything. However, the euro has kept on going up and up and up. One of the reasons the euro goes up is because we have a trade deficit. And even though the trade deficit got better between 2007 and 2006, because we've been going into recession, we're buying less goods from overseas, and the dollar is down, so we're selling more. But the fact of the matter is the euro's been going up. So meanwhile, we came out here, we have the situation. Bernanke went on the news. Bush has gone on the news. And there's big talk on both sides of the aisle about a stimulus package. Now, there's two ways to handle potential recession. One is monetarist. in which case we go out there, we lower the interest rates, we adjust the value of money, and so on and so forth. The other is fiscal, and that is to come out with a stimulus package that hits the economy and directly encourages people to make money. That's what's going on over here. I had written some notes, which I don't have available to me right now. But the Republican side, Bush has come out with a state of the economy. The Republican side basically says, let's spend between 100 and 150 billion, all for tax cuts, rebate check that goes into the middle-class Americans and upper-class Americans, which will be spent and will encourage consumer spending. Also, capital gains, decreases in the amount of time somebody can write off not a capital gain, but a capital cost, which is also a very, very good thing for business. Encourages businesses to buy capital goods and to invest in the economy. That's basically what happened in 2001, and that was also accompanied by tremendous drops in the Fed funds interest rate. Now, what I'm going to do is I'm going to show some slides over here. So I'm going to look away. I'm going to disappear myself, and I'm going to switch. And what I have over here is the S&P 500. And you'll notice that over here was the big 90s rise over here, and the internet boom, and here is the big collapse over here. And then since then, the S&P's just been going up and up and up, and it's even higher, you notice, than the top back during the Clinton administration. And people are very, very proud and interested in that. Let's see if I can get rid of the Fed pride. And a lot of people have come to me who invest in the C fund, the TSP, and said, look, I'm better than I was back in 1999, 1998. Here's the low. The next thing I'm going to show is the euro against the dollar. So here's the euro versus the dollar over here. And you notice that back in the early 2000s, it starts in 1999, so it's a different group. Euro was down, and then the euro started going up. Adjusted itself a little bit, and now the euro is just through the roof at $1.46, just unbelievably high. And why is the euro going up? The euro is going up because we have a tremendous trade deficit and a government deficit. We're basically spending more than we can collect taxes, and we're importing more than we export. Okay, now here is something that people aren't going to see. This is the S&P in euros. What does this mean over here? Well, I showed before that the S&P had started high during the late 90s, had gone down, and then gone right back up to what it was worth before and even higher. Well, if we adjust that for the value in euros, let's say a European bought the US S&P, and this is what has happened to it. And what has happened to it is that it never really went back up. Here's the bottom, about the same as the bottom in the regular S&P, about 800 at 800, and it went all the way up to about 1100. And now it's down here at 900. And that's because of this latest drop. So the S&P and the stock market really haven't gone up at all. And that's a surprise. I'm going to get rid of that and go back to Google. So what does this mean? This means that the market is almost down to its lowest low during the last recession in the value of euros. And euros are an incredible currency that's becoming the next reserve currency, basically replacing the dollar. So that means that our stock market really hasn't gone up much at all. And this last drop has brought it not quite down to the bottom of the last recession, which was a low bottom, about 55% of its top, but it has gone way, way down. So what does this mean? This means that we are in a recession. This is very, very significant, and we need to do something to get out of it. But whatever we do is going to actually hurt the value of the dollar. We have been used to being the reserve currency. And as the reserve currency, basically, we had complete control over our own currency, and we could do whatever we wanted to. If we wanted to reduce interest rates from the Fed funds rate from 6% down to 1%, we could do it. Wouldn't affect our relationship with the rest of the world. Well, now it does. So as we do these things, which were customarily done to fix recessions, all we're really doing is reducing the value of the dollar, and in real value, and let's just say that euros do represent real value. The European economy is even slightly larger than ours, but it's also being adopted by Russia and some other countries as a reserve. In the real value, we're not helping ourselves at all. So we need to help ourselves. We need to strengthen our dollar. How do we strengthen our dollar? We strengthen our dollar by importing less, exporting more, and telling the commodities markets that we are a player in the price of oil. And if you're going to speculate the price of oil up to $90, we're going to increase our mileage by 40%, and we are going to import 3 million barrels a day less than we are now. That pretty much offsets, at least for the next decade, the increase in the use of oil by India and China, which are going up and up and up. There were some articles that I've read this week where basically I already talked about Chevy, which is GM, going out there working with China to come up with a plug-in hybrid, and they're actually going to come out with a plug-in hybrid called the Volt in 2010. Now Toyota, which of course is equally about the same, sometimes first, sometimes second, largest producer of automobiles and seller of automobiles in the United States, they're talking about coming in with a plug-in hybrid. What does a plug-in hybrid do? Plug-in hybrid basically increases the mileage in gas to 100 to 150 miles a gallon by having you plug in your car at night. Doesn't increase really the use of electricity because we have to run our plants at night where they're not in full capacity. And basically we can charge up our cars in the first 40 miles of the day, which is within most people's commutes, are basically free of buying gas. And that, as a result, increases the mileage tremendously. Now, it doesn't improve climate change because most of our electricity is produced by coal. But what it does do is it replaces American energy with foreign energy. And it really, really will hurt imports of oil. And imports of oil and gas and energy is about 1/3 of our present trade deficit. So as the dollar is already low, we're increasing our exports. If we decrease our imports, then we will have a tremendous improvement in the dollar and in the value of the dollar as well. In which case, if we actually have an increase in the value of our stock market or the value of our homes, it will mean something. It will actually result in an increase of the value of our assets, and which it is not now. And that's what that chart that I showed, which was the stock market in euros, basically pretty much flat for the last 4 or 5 years. So our market increase for the last 4 or 5 years to record levels has basically meant nothing. In real value, it has been flat, and in real value, this last collapse has really brought it all the way down the market to recession levels. And of course, we are in a recession. My name is Reed Silverne. Name of the show is Fed Pride. The reason it's called Fed Pride is because I'm a federal worker, now retired, and proud of it. Thank you for watching. and I really appreciate that.